Markets tumble after Fed Chair Powell warns of rising inflation and weakening jobs. Here's what you need to know. So, the Fed appears to be caught off guard by the magnitude of the tariffs. Powell noted they were well beyond their worst case scenario expectations. Now, we've been talking about tariffs nonstop recently and not really going to delve deeper today. So let's focus on the Fed's game plan. First, Powell's warning of higher inflation and slower economic growth. However, he notes economists downgrading outlooks, but doesn't see the US slowing into a recession just yet. Market pundits are likely a little more on the bearish side with stagflation chatter. Stagflation is high inflation, slow growth, and high unemployment. Essentially, a poor economy compounded by higher prices. So, while not overly pessimistic, Powell is still warning of deteriorating conditions and a scenario where the Fed's two primary objectives, inflation and jobs, may conflict. So, what happens here? Powell called it a quote unquote challenging scenario, obviously. However, the Fed would prioritize whichever objective was further away from its target. Now, this is where markets started to tumble. Powell noted employment was relatively stable while inflation progress may face additional challenges. This commentary felt hawkish and seems to be favoring the inflation side of the equation. This perspective was likely further cemented as Powell reiterated no hurry to cut rates and wanted to continue its wait and see mode. Now, this isn't surprising as the Fed has typically been notoriously slow to react. However, this gave the market jitters as the Fed seems unlikely to try to get ahead of any potential impact. So what now? Well, the next Fed's meeting is in early May, but likely not much to see there. March inflation was a positive surprise, but it's pre-tariffs. We might not see a tariff impact on inflation for a couple more months due to built-up inventory and tariff policies are still in flux. Job markets may be slowing, but unlikely to show any significant weakness yet. We'll likely need to see companies to sour on their outlooks for that. Meanwhile, companies are reporting Q1 earnings now, but again, Q1 was mostly unaffected. We could see some outlook warnings, but hard results won't likely be until Q2 in July at the earliest. However, we could get whiffs of layoffs picking up ahead of that. Finally, consumer confidence has already tanked, but we'll still need to see it flow through. Spending still appears to be strong, but potentially due to consumers trying to get ahead of the expected tariff impact. Again, we'll need to see more time to see any change. So I guess we're all in the Fed's wait and see mode for now.